Be sure to subscribe to the podcast wherever you listen to podcasts and on YouTube. So, Al, as we get into this next segment and topic, I mean, we talked earlier about the market is different than the economy. It's the market
Mhm.
is itself. Call
Right.
it its own entity almost, right? And the institutions, we know they rule that market. We talked about last week how the majority of investing in the equities markets was the institutions. There's only about roughly, it's a little bit lower than 20% that's actually the public
Controlled by the
investing.
public.
Yeah,
That's right.
controlled by the public. So now we know that. I mean, that's a stat that we pulled out of, I forget the source. We can get that if we need it. But now knowing that with the market going up and down, I mean, it's moving very fast and it's created by these institutions. And we call it supply and demand, right? Just like how anything else moves in the market. And if you think of supply and demand in the market, think of it as an auctioneer. So explain, Al, what supply and demand really consists of, how the markets function, but it's kind of like an auctioneer.
Yeah. Well, first of all, if you're going to be in the financial markets, the goal is to be able to identify buying and selling opportunities and then be prepared to take advantage of them. The great thing for us is that somebody's already doing that. Somebody's already making that determination. It's the institutions, what we call smart money, the big Wall Street firms, the hedge fund managers, the big boys that have billions and maybe even trillions of dollars to invest.
Maybe even
So
Uncle Warren.
and we'll throw Uncle Warren in there. But they're determining if there's a buy or a sell opportunity, and because of how they have to enter or exit, they leave a trail that we can use to know in advance where they're going to be active. So if you, as a retail trader, novice trader, if you're trying to find opportunities without the institutional help, basically you're guessing with a high component of hope and prayer. And that smart money that we're talking about, that's money that's being invested by Wall Street elites. They have massive amounts of resources to get access to market information before the rest of us get it. Maybe we never get it, but that gives them a massive advantage. They really know what the true value of something is. They know when it is overvalued. And these institutions, these big boys, the smart money, they don't just trade once or twice a year. They're trading daily. They're trading on a repeatable basis. This is something that's reliable, that we can count on. As long as Wall Street is functioning, the market is open, these opportunities take place. The supply and demand component of it, that really is what moves the price of anything in any financial market. And it's really a fact that can't be argued. When there is more demand for something, in other words, more buyers, price is going to go up. When there's more sellers, price is going to go down. So the key is to be able to identify where the buyers and where the sellers are in the market before they actually get involved, before some of their entries or exits take place. That is something that our core strategy, which is our foundational strategy that our students use for anything that they're trading, any time frame, any asset, that's what that does. It identifies that institutional smart money activity where their unfilled orders are that are going to become filled orders. That's when you want to be into or out of a trade before those orders hit the market. Because once they do, then the price is moved away and a big part of the profit may be gone. What we found is that the best trades, what we consider a quality trade that we want to be the goal of all of our students, would be a low risk entry with a high profit potential and a high probability of succeeding. That almost always happens as close as possible to the turning point in price. And that turning point in price really is impacted by the institutional activity. So instead of following someone's opinion, instead of following what you think should happen, just follow what is happening. Follow what's factual, what factually moves the price of something on a reliable basis. And that's just basically copying the institutional activity. That's what our core strategy does.
I'm glad you brought that up about, the public and people, us as, regular retail investors. A lot of people are guessing they're really guessing their financial future.
Sure.
You need a strategy. You need to follow a rules-based strategy. And a lot of people say, oh, I bought this, so-and-so stock because I just had a gut feeling that it was going to go up. Well, the institutions, they don't care about your gut, right? They don't care about us. They are there to move the market. But you were talking about core strategy. Our sponsor, Online Trading Academy, has a core strategy that's designed to help you identify where those big banks are buying,
Mhm.
but also where they are selling at low risk, high reward, high probability entry points into the markets. And that's where proper investing and trading, that's where it all lies.
Right.
We talk about, supply and demand and core strategy. Explain a little bit about multiple assets, because a lot of people think that the smart money, the banks, institutions are just buying stock, right? Well, they are using fixed income assets, right? Where they have leverage. They also have an opportunity to trade and invest any time of day. Now, explain these leveraged assets, these other markets that they're using, and some of the perks and why we can also use them as well.
Well, I think it's important to understand that these Wall Street firms have kind of different components to their business. Some of them get involved in IPOs, in other words, taking a company public, maybe mergers and acquisitions. Maybe their clients they get some constant actually money flow from their clients, but a lot of them, the majority of their profits come from trading, the trading that they do on a
Mhm.
regular basis. And that's really where what we kind of piggyback off of. But people want to know why the Wall Street firms use different investment vehicles and they put their clients in. It's because of that component, that trading component of their business. And they know that they're not going to have the kinds of returns that they desire by trading in mutual funds, for example. They'll put their clients into a mutual fund because that is a great way to have just a constant source of income from the clients. Most of these companies now have gone to kind of an asset-based, fee-based, I should say, fee-based program where they're just getting a percentage of what you have in your accounts on a regular basis. That's a great business model
Yeah.
for them because they don't have to be that active. They're more active with their own money. They're trading their own money, and basically they're kind of leveraging off of what you have within their companies too. Why are they using different things then to boost the returns? Because they know that there are other assets that give them the opportunity to have better returns, higher probability trades. And those are things like the futures market, the foreign exchange market, the options market. One of the big advantages with those is leverage. And here's a kind of an example of how that would work to create an opportunity, an edge for you. You go to the state fair. In fact, we do this show at the state fair
You are
usually,
correct. And
except for
actually,
this last summer,
you're exactly right. And
unfortunately.
that's the only time I go there too.
Well, I love going to the state fair. I'm kind of a pork chop guy. I know you like lean hogs,
Yeah,
but
that's true.
but
That's
I
true.
like the pork chops at the state fair. But let's just say that you go to the Midway and you go up to one of those booths where you throw a ball at the bottles.
Hmm.
You pluck $1 down and they give you 3 balls.
Yep.
The guy standing next to you puts his dollar down and he gets 100 balls. Who has the greatest opportunity of being successful at that booth?
It's the second guy.
Absolutely. Well, that's the same kind of thing you can do in the markets with leverage. That dollar that you're putting into whatever the investment might be is going to give you a multiple of it. Maybe not the 3 balls for $1, but maybe the 100 balls for $1. It's sort of like making a down payment on something like a mortgage within the financial markets. You can do that with the futures market, the foreign exchange market, the options market. We're looking at leverage. It might be 10 to 1. It could be over 100 to 1. That's what the institutions are using because they know the value of that leverage. They know the value of the multiple of their investment dollars. And we as investors and traders, we can use the same assets. We can take advantage of that leverage, but you need to know what you're doing. You need to know what the individual characteristics of each of these assets are, and you need to know how to have protection, but then you're able to take advantage of what the big institutions are doing to really boost their bottom lines.
Yeah, I mean, the great thing about these, I mean, think about this. The futures market is, as you were talking about your commodities, your gold, oil, silver, lean hogs. A lot of
Yeah.
people only
And the
want to,
major stock
yeah,
markets.
a lot of people only want to trade stocks. Well, you can trade the major stock markets within the futures market.
Right.
Utilize your capital efficiently. One thing that Al didn't mention is these markets are open around the clock, right?
Right.
They're open from around the clock during the week. So people that work during the day still have the opportunity to trade and invest at night. I mean, in the forex market, that's a currency market. You're
Right.
trading one currency against another. It's called a pair, right? So I mean, think about this. What so many people love about the forex market, it's a slow moving market because it takes countries a long time to change monetary policy. They have to. They can't have monetary policy change that fast. It hurts the companies that do business with their
Sure.
country. So, I mean, these opportunities are out there, but people just aren't told about it. They're not talked
Right.
about on TV. They're not taught. Now, coming up next, I want to get into retirement, but not just buy and hold. How to use different techniques and strategies within retirement accounts, 401ks, IRAs, and how to protect capital in there. This is Josh and Al, Investing with Confidence. We'll be right back.